Hello, this is Amir Blackwell, Micaiah Walker, and Johnny Withers, first year 5-year MBA majors presenting our financial accounting project.
ONYX is an accounting branch based out of Atlanta, Georgia, a part of the NextGen Incorporated. NextGen is a company that provides the next generation with portable communication devices. The company's initiative focuses on promoting team productivity through community service. ONYX goals is to collaborate with future business leaders of tomorrow to teach teams the accounting cycle step by step through key concepts.
The first step of the accounting cycle is your journal entries. Journal entries record accounts, including debits and credits, in a journal. A journal gives a complete record of each transaction in one place. A journal entry includes the following: your date of transaction, titles of affected accounts, dollar amount of each debit and credit, and explanation of the transaction. From the example below, you can see how to properly record a journal entry.
The next step is the T accounts. A T account is a T-shaped chart that holds the accounts from the general ledger. Basically, with a T account, you get a specific account and you add up all the debits and add up all the credits from that account and then find the difference. So now we'll talk about the unadjusted trial balance. Unadjusted trial balance is a list of accounts and balances prepared at the end of the reporting period before accounting adjustments are recorded and posted. The unadjusted trial balance is used as the starting point for analyzing account balances and making adjustment entries. Also, you may notice an example that both the debits and credits must equal at the end. The next step is adjusting entries. Adjusting entries are made at the end of the accounting period and are made so assets, liabilities, expenses, and revenues are correctly reported. It is helpful to have these entries because you are recognizing revenue or expenses by estimating when you receive the payment or record the actual expense. For example, if an item or service is paid in advance, the general journal entry will be made for a prepaid expense and considered an asset. It wouldn't be recorded as an expense until the service is performed or the item that is brought is used. So what should you understand about adjusting? Accrual-based accounting is recognizing cash or expenses that have been received or paid, similar to revenue recognition. Cash-based accounting is recognizing revenue when cash is received and expenses when they are paid. The two main principles that are associated with adjusting are expense recognition, which is record expenses when they have occurred, and revenue recognition is record revenue when earned. What you should always remember is that the cash account, is not to be used in adjusting entries. If you paid or received cash after expense or revenue was recognized, you are dealing with accrued expenses and revenues, accrual-based accounting. And if you paid or received cash before expense or revenue was recognized, you are dealing with prepaid deferred expense and revenues, cash-based accounting. These tips about adjusting should help you understand how to do the entries of adjusting in the example. After adjusting, you can move on to the next step, which is adjusted trial balance. An adjusted trial balance is an adjusted list of accounts that are made after adjusting entries have been recorded. Just remember, this is just an update of all the accounts once items have been used or is no longer functioning. As you can see in this example, that you have your unadjusted trial balance, your adjustments, and your adjusted trial balance.
The adjusted trial balance is based on adding or subtracting the adjustments. If it's a debit, you would add, and if it's a credit, you would subtract from the unadjusted trial balance to achieve the adjusted trial balance. Next, we will be talking about the financial statements. There are three financial statements: the income statement, statement of retained earnings, and the balance sheet. The income statement is when you subtract expenses from revenue to get the net income. You take the net income to the statement of retained earnings and add that to your beginning retained earnings. You subtract your dividends and get your ending retained earnings that you take to the balance sheet. Your balance sheet contains assets, liabilities, and equity. Your total assets are supposed to balance your total liabilities and equity. Remember that your balance sheet is for a point in time, not a period of time. Next, we will discuss how to close accounts. Closing accounts is a four-step process. Step 1 is to close income statements to credit balances. To close this account, you will debit revenue and credit income summary. Step 2 would be to close income statements to debit balances. To close this account, you would debit income summary and credit all of your expenses. Step 3 would be to close income summary account. To close this account, you would debit your income summary and credit your retained earnings. The last step would be to close your dividends account. To close your dividends account, you would debit retained earnings and credit dividends. The last step of the accounting cycle would be your post-closing trial balance. A post-closing trial balance is a trial balance which is prepared after all the temporary accounts in the general ledger have been closed. The temporary accounts include the income statement accounts consisting of revenue, expense, gain, and loss accounts, the summary accounts, and the few temporary balance sheet accounts such as the sole proprietor's drawing account or the corporation's dividend account. Once both your debit and credit balance, you have completed the accounting cycle.